Donald Trump, the newly elected US president, was initially expected to be beneficial for the markets. However, after a strong start, his unpredictable tariffs are now negatively impacting the stock market. The S&P 500 index has dropped nearly 5% since the beginning of the year, and if we look at its peak from last year, it has declined by almost 10%. The famous Fear and Greed Index indicates that retail investors are in a state of total fear and are selling off their positions. This means that finally, after years, the right phase has arrived for us smart investors. As Warren Buffett famously said, "Be greedy when others are fearful." And right now, there is indeed blood on the streets. Some of the best and highest quality companies are currently cheap and on sale. In this video, I will go over 5 of the top most undervalued companies based on their prices today. We will analyze their current standing, whether now is a good time to buy, and I will share my personal opinion on each stock. And I will tell you right now, the last 5th company on its list is my absolute favorite. Hi, my name is Dominic and welcome to another investing video. One of the highest quality yet most underrated companies in the market today is Google, Alphabet, which has dropped over 13% since the beginning of the year. This year I've already purchased Google stock twice, increasing my position at prices of $183 and $167 per share. Looking at Google's price to earnings (PE) ratio today, we see it's slightly above 20. This ratio is calculated by dividing the stock price by earnings per share. If company has a PE of 10, it means investors are willing to pay 10 times the company's annual earnings for its share. A low PE below 15 can indicate that the company is undervalued, while a high PE of 30, 40 or more suggests overvaluation or high growth expectations. For reference, the PE ratio of the entire S&P 500 index is currently above 27. This means that Google, one of the largest and the most high-quality companies in the stock market and the world, is currently valued lower than the average company in the index. Taking a deeper look at Google, it's important to compare historical valuations metrics. I often use stock analysis for this, where I search for Alphabet, go to its financials and ratios, and examine the company's numbers over the past years. We see that its PE and forward PE, meaning its expected future PE, are currently at their lowest levels in the past 5 years, except for a dip in 2020 when markets experienced significant declines. This quick analysis shows that Google is relatively cheap compared to its historical valuation, which is why I bought more shares during these declines. If Google continues to drop, I will aggressively add to my position. At today's price, I consider Google an undervalued stock. Another company I currently see as very cheap and hold in my portfolio is Amazon, ticker AMZN, which has fallen over 10% since the beginning of the year. I made 3 purchases this year as Amazon's price kept dropping. A few months ago, Amazon was trading at $240 per share, and today it's under 200, a decline of about 20% from its all-time high. This is for one of the most high-quality companies in the world and one that will likely be around for centuries. Amazon's decline is primarily due to political risks, including tariffs imposed by Donald Trump. When analyzing Amazon, it's crucial to look at its different business segments. Amazon is a massive company with various divisions, including Amazon Prime, retail, AWS, cloud computing, robotics, and even autonomous vehicles. The higher margin segments are growing faster than lower margin ones, meaning AWS is expanding more rapidly than its retail business. Looking at Amazon's last quarter, revenue increased by 10.5%, net income grew by 80%, AWS revenue rose by 19%, and e-commerce revenue increased by 7%. Based on my analysis, Amazon had a very strong quarter. I think fair value estimate for Amazon is $195 per share. My valuation method is based on discounted cash flow models, DCF, financial ratios and relative valuation compared to the company's historical performance and its competitors. While analysts' forecasts are slightly weaker than expected, my expectations for Amazon were met. This is because I tend to be more conservative in my predictions compared to analysts who often get caught up in the hype. I take a more cautious investing approach. At a price below $200 per share, I see Amazon as an excellent deal, which is why I've been adding to my position. I currently classify Amazon as an undervalued stock. The portion of my portfolio dedicated to individual stock picking, active investing, is expanding once again. This year, my portfolio has been closely tracking the performance of the S&P 500 index. When I started investing 10 years ago, at the age of 20, with just a few dollars, I quickly realized that in investing and finance, if you want to accumulate more wealth, one thing is essential: organization. My goal here is to teach you how to invest profitably. That's the first part. The second part is to help you maintain a clear overview of your investments and finances so you can grow your wealth more effectively. Another undervalued company in my portfolio is ASML. I bought shares of this company last year, and I will tell you, ASML stock has been fluctuating around the same price for a while, despite its fundamentals improving each quarter. The biggest risk for this company is the decline in demand from China, but I believe this risk is already priced into the stock. ASML is currently undervalued, and my most recent purchase was at $680 per share. Today the stock trades around $700, so I'm slightly in profit. However, I still consider it undervalued. The fourth company on my list is PayPal, which has been the hardest hit among the stocks I'm discussing today. It has dropped over 20% this year. I made 3 purchases over the past year, some even below $60 per share. PayPal Holdings is a financial technology company that provides digital payment solutions, essentially functioning as a digital banking alternative. Last year, PayPal's revenue grew 4% quarter over quarter and 7% year over year, while total payment volume increased by 6%. I view these numbers as relatively solid, though they could be better. My main reason for buying PayPal now is my confidence in its management, particularly CEO Alex Chriss. With a strong management team and an undervalued stock, I believe the market is overlooking PayPal. That's why I bought shares and currently consider PayPal undervalued at today's prices. And as I promised, my final pick, the cherry on top, is my personal favorite alongside Google, AMD. This chip manufacturer has suffered a massive decline, down 17% this year and roughly 50% from its all-time high. My first purchase this year was at $98 per share, so I'm slightly in profit. I believe this steep 50% drop from its peak is not justified by its fundamentals. Yes, AMD was overvalued at its all-time high, but at today's prices, it's no longer expensive. In fact, I believe it has been punished far more than it should have been and is now trading below its intrinsic value. That's why I personally bought AMD and consider it one of the best quality companies that is currently undervalued.